Hello, everybody. We are in week 5. I cannot believe we're already in week 5, and that's absolutely awesome. And this week, we are going to be concentrating on studying for our first exam. Now, over the next week, I will be sending out the requests for uh, the uh, proctor locations. And so you should be getting that hopefully soon. And once that's in, you can schedule your appointment with the testing center, and you will have 1 week to do it. And so here we go. We're going to do the review this week. Again, if you have any questions, please do not hesitate to ask. So, the exam is going to be over 4 different chapters 1, 2, 3, and of course 9. And this review really gives you a heads up in regards to what to study. So, if you can hit everything that's on here, then you should be okay for this exam. Now, how to prepare, take a look at the note packages that you were given each week. They're going to be your main study guide, and review and rework all the problems. You've been given the answers to each one of the homework assignments. Make sure you know all the information on those homework assignments too, and that will help you get through this test. Refer to the book when you need additional clarifications from your note packages. You will not be tested on anything that is not in the note packages. That's the key to remember. Always remember what we've been covering is exactly what's going to be on the test. Now, um, number 3, rework all the homework problems. Do practice, practice, practice. Practice makes perfect. So make sure you touch base on each one of the homework problems. If you did not understand them quite when you did them the first time, look at the solutions. And again, if you have any questions, please do not hesitate to ask. Review your quiz 1. That will have a lot of the different types of questions that's going to be on the test, and study 2 to 3 hours will not produce a passing grade. Make sure when you go into this test that you have taken a lot of time to understand everything and know everything. Now, exam information, there's going to be 35 to 40 multiple choice questions. 3 to 5 of them are going to be open end questions, and these are things that you're going to have to basically show your work for. Make sure you do show your work, because I will give partial credit out to those who did show their work if you don't get the right answer. Um, they will be on Blackboard, so when you go into the testing center, you'll be given a password to the exam, and it has to be taken in the testing center. You can't take it outside the testing center. There are no makeups, and it's unlimited time, so you have as much time as the testing center will allow you to have. It is each student's responsibility to contact the designated testing center and inquire about the hours of operations. And pretty much appointments are required. Just make sure you set up an appointment. That way you have enough time to take the test, and they have a place for you. The test is 160 points, or 16% of your final grade. A calculator is required, so you need to take a calculator. They're not going to provide you any calculators, but you can't take your graphing calculator, and you can't take a cell phone. It has to just be a regular scientific calculator. And then scratch paper, they will provide you scratch paper at the testing center. Again, if you have any questions, please do not hesitate to ask this. Now, the first question we're going to be talking about is chapter 1, and we're going to be talking about the value chain of accounting. And so, if you look in your book, uh, at the bottom, I believe on page either 6 or 10, let's just double check this here. Um, yeah, page 6, you have the value chain at the bottom. And this is one of those very first assignments that we did, where you had to determine which part of the value chain they were part of. And remember, the value chain parts were research and development, design of products and processes, production, marketing, distribution, and customer service. So you need to know what goes into each one. Uh, So, and also you need to know what type of activities are value added activities and which ones are non value activities. So, added activities are those that customers perceived as valuable, and non valuable are activities that do not add value to the goods or services from the customer's perspective. So, make sure you know the difference between those and what type of activities will fall into where. Okay. Now, the next part you need to know about is the difference between financial and managerial accounting. This, of course, was one of those questions that was on your first homework assignment. So remember, financial accounting deals with the past, managerial accounting deals with the future. Managers deal with managerial accounting, whereas the financial goes to the outside. Those are kind of the different things that we talked about in that first homework assignment. And then how does accounting fit into organization? And this chart says the accounting information system, and then managers make decisions that determine the performance of the organization. And of course, then they evaluate the performance of the organization and the managers. So make sure you know the difference there. The other thing I don't think we touched a whole lot on in the chapter was just in time, ERP, lean accounting, such. What I would concentrate is what is just in time. And remember, just in time basically is when the materials get to the production site right when they are needed. A lot of companies go to this to cut down on the raw materials that are stored inside the house or inside the building. So basically, just in time accounting or just in time products are the products getting to the production line or production location at the time that they're needing. Know the different types of accounting titles, the CFO, the controller, and then just touch base on ethical issues. How does it fit into cost accounting? The effects of product costs, cost of goods sold on the income statement. Accounting information is used to evaluate the performance of managers. Accountants who prepare the numbers are under constant pressure to make accounting choices that will influence performance reports. Um, and then, of course, the Sarbanes-Oxley Act of 2002 requires managers to attest the adequacy of their internal controls. Um, you'll have a little bit on this, but not a whole lot. So just keep that in mind. Now, some of the terminologies that you will need to know about is costs versus expense. What is a cost? It's a sacrifice of resources. Expense is a charge against revenue. So you need to know the definition of cost and expense. What is an opportunity cost? That's another one that you need to know. What did you give up to get what you got? And then land, of course, remember, land is the only cost that in the first chapter we talked about that we don't have any kind of depreciation or anything with that. The cost object, you need to know what a cost object is, which is like a product. Like we talked about the BMW, I believe it was. That is the cost object. And then what parts go to that, whether they're direct costs or indirect costs. And remember, direct costs would be what we can trace directly to that vehicle. So tires, steering wheel, direct labor, things that we can tie directly to that vehicle. Indirect costs are the overhead, the things that we can't drive to a particular vehicle or particular product. Those would be like insurance on the building or maintenance on the building or taxes, depreciation on the equipment, things like that. So indirect labor would be like the salaries for the supervisors. So those are just a few of the different types of indirect and direct costs. So you need to know the difference between those two things. Now, you need to know what product costs are. You need to know what prime cost and conversion cost and period cost. Product costs, let's start with that. Record it as inventory on the balance sheet until it's sold on cost of goods sold. So this is where we have the three different rooms, the raw materials, and then we have the work in process, and then we have the finished goods. And all those three categories are on the balance sheet as inventory. Then once we sell the product out of finished goods, it moves from the balance sheet over to the cost of goods sold, which of course is on the income statement. Things that are in product costs, direct materials, direct labor, and then the manufacturing overhead, which is both variable and fixed. And remember, variable is driven by the number of products that you produce. Fixed is just a fixed item. You can't change that no matter what, how many products you produce. We have indirect materials, indirect labor, and other overhead, which includes the insurance, the rent, utilities, taxes, and such. So just keep those in mind, variable and fixed, if it's direct or indirect. And I believe we had a homework assignment that talked about this. So I would highly encourage you to go back and take a look at that homework assignment and make sure you understand it. Prime costs. You need to know the how to calculate prime costs. Prime costs are just your direct materials and your direct labor. You have to know how to calculate that. You also need to know how to calculate conversion costs, which is direct labor and manufacturing overhead. So basically, if you're given your conversion costs and you're given your manufacturing overhead, you can take the difference between those two and get your direct labor. So you have to know those formulas. Your period costs, which are non manufacturing costs or selling administration costs. So these are costs that has nothing to do with the actual making the product. This is going to be your office expense, your selling expenses, and things like that. In other words, think of it as your corporate expense. They're never assigned to a product and they are expensed when incurred. Okay. So again, your differences between variable and fixed with regards to total cost and cost per unit. Variable expenses, they change with volume. So basically, the more you produce, the higher your variable expenses are going. But the cost of per unit does not change. So a tire could cost $50 per tire per car. So that would be $200 because, of course, the car has four tires. But that $200 never changes, but the total amount you pay for the tires will change depending on how many vehicles uh, you make. Now, fixed cost remains constant. So that means that my insurance for the building, say, is $10,000, but my insurance per vehicle, that I would apply to per vehicle will change as the more uh, vehicles that I produce. So if I produce 10,000 cars and $10,000 in fixed cost, that would be $1 per car. Now, if I raised it to $20,000, or I'm sorry, $10,000 of fixed costs and 20,000 units, then it would be 50 cents per unit. So the fixed costs remain the same, but it changes with volume. The more you produce, the lower the cost per unit it's going to be. Semi-variable, think of semi-variable is you have a fixed cost and then a variable cost. A perfect example would be a U-Haul, whereas you purchase it or you rent it for 19.95 and then you're charged every single mile. So that would be a semi-variable cost. A step cost, the example that we were talking about in the book talks about two trucks. Each truck has a maximum of 120,000 miles. So your cost per truck is 80,000 mile or $80,000. So as long as you stayed under 120,000, you had $80,000 in cost. As soon as you went over 120,000 miles, you had to purchase a second vehicle, which was another 80,000, and that was good for 120,000 miles. So step up, basically, you're good for a range of products, and then once you get past to the highest level of that product, you have to step up to the next one, and that's what step up is. You need to know what that is. All right, so here's a practice problem, and let's go. Complete the answer sheet for the following, placing an X under each one. So we're going to have a variable cost or fixed cost, and then it's going to be a direct materials, direct labor, manufacturing overhead, and period costs. So now remember, what is a period cost? That would be something that's not deleted or associated with the product itself. Now, security guard wages for the factory. That is going, it says hourly, so that tells me it's going to be a variable cost, but it's going to be a manufacturing overhead cost because that doesn't tie directly to the product itself. Cost of direct materials. Well, cost of direct materials will be a variable cost because that depends on how many products we produce, and of course, that's a direct material cost. The salary of her production supervisor, that is going to be a fixed cost because your salary is not going to change. And that's going to be overhead because we don't know which particular production he is going to be going up against. The cost of direct labor, that's going to be a variable cost because direct labor changes, and then it's going to be under direct labor. Equipment rental cost, well, that is going to be a fixed cost and it's going to be overhead. The depreciation on the building is going to be a fixed cost, and that's going to be overhead. Marketing cost, that could be a fixed cost or a variable cost depending on the type of marketing it is. And then, of course, that's going to be a period. Shipping costs is going to be, it could be a direct materials or oh, it would be a manufacturing overhead or a period cost, depending on what type of shipping you're talking about. And it could be variable. The electricity cost, that's going to be variable because it depends on the amount of electricity you use, and that's going to be an overhead cost. Clerical staff of administrative offices, that's going to be probably a variable cost if they're paid hourly, and that's going to be a period cost. Now, this is the part where we had a couple of assignments that we did in regards to determining the different costs of goods manufacturing, cost of goods sold, and they're giving us some of this information. So remember, you need to know this and how to figure out the balances. I do T accounts, or you can use these formulas, and you can do it both ways. So raw materials, you have your beginning balance plus your purchases minus your transfer to work in process equals the ending balance. The work in process equals the beginning balance plus your direct materials plus your labor plus your overhead minus your cost of goods manufactured gives me your ending balance. And then in your finished goods, you have your beginning balance plus your cost of goods manufactured minus your cost of goods sold, and that equals your ending balance. So, given the information on the next slide, I'm going to switch over to an Excel spreadsheet so that you guys can take a look and see exactly how I figured these out. All right, so the information that they provided into this for this particular problem, they said our beginning balance for raw materials is 12,500. So the first thing I'm going to do with all of this is just plug in the numbers that I know, and then I can back into what I don't know. So beginning balance was 12,500, and I'm going to go change these so that I can look at these much easier. So much easier to the eye. So then it says my purchases for raw materials were 189,000. My ending balance for raw materials was 14,300. My beginning balance for work in process was 24,500. My ending balance for work in process was 23,100. My direct labor costs were 89,700. My manufacturing overhead that was applied was 65,300. My beginning balance in finished goods was 28,900. The ending balance was 24,300. And really, we don't care about the sales, the selling expenses, and the general administration because those things were not included. I really cannot spell beginning, can I? All right, so So the first thing I can figure out is the transfer. Remember this formula, it's the beginning plus the purchases minus the transfer equals the ending. So what I'm going to do is I'm going to add the beginning and the purchases, and I'm going to subtract the ending, and that gives me 187,014,300. I'm sorry, 187,200. And just to double check my math, I'm going to add it up and see we have purchases minus the what's transferred out. That gives me 14.3. So I'm good there. Well, that's 187.2 goes over here, 187,200. And so remember, how do I figure this information? I take the beginning plus the direct materials plus the labor plus the overhead minus the cost of goods manufactured and gives me my ending. So what I'm going to do is add these up, 24.5 plus 187.2 plus 89.7 plus 65.3 and subtract the ending, and that gives me 343,600. So now let's just double check that. We're going to say plus all these, minus the cost of goods manufactured, 23,100. So I'm good there. Well, then the cost of goods manufactured goes over here. And again, beginning plus cost of goods manufacturing minus cost of goods sold equals ending. So if I add these first two together and I back out my ending, I get 348,200 as my cost of goods sold. And just to double check my numbers, yes. So the question was, what was cost of goods manufactured? So I go back over here, it was 343,600. You need to know how to do these. So please, if you don't understand how to do these, please ask. Then that way you understand how to do this kind of stuff. So let's switch back over um, to the PowerPoint. Okay. All right. So please, if you have any questions on that, please ask. Okay. So now let's take a look at the next one. And we're going to do the CVP analysis. Some of you had some issues with this. And, but again, let's go through this. And if you have any questions, let me know. Now, profit volume analysis, this would be a good idea for your note card because remember, you get a 3x5 note card, one side of notes for the test. So you might want to put this information on that note card. The break even point, you have to know how to do that, which is your revenues minus your variable costs minus your fixed costs. They all have to equal zero. Your target profit, you take the same formula except for zero, you say the target profit. The margin of safety, how do you do that? You take your current sales dollars minus your break even sales dollars. The ratio, you take your margin of safety and divide it by your current sales dollars. Income before tax or income taxes before net income equals after tax income divided by 1 minus the tax rate. Multiple products, we have to have the contribution margin, the package contribution margin. And contribution margin per unit, revenue per unit minus variable cost per unit, or total contribution margin is the revenue minus the variable cost. The ratio, you take the margin per unit divided by the sales price per unit to get the contribution ratio. So you need to know these formulas, please. And if you have any questions on how to use those, don't hesitate to ask. All right, so Milner Company produces tie racks. The estimated fixed cost per for the year is $288,000. The estimated variable cost per unit is $14. And Milner expects to produce 60,000 units. and the tax rate is 35%. All right, so calculate the break even in units and cell dollars. So the first thing I have to do is I have to take my 6,000 or my 60,000 times the number of units. Or we have $20 per unit, $60. So $20 per unit times 60,000 units minus my variable cost times the number of units minus the fixed cost equals 0. Okay? So let's take a look at this on Excel. So we had 60,000 units. My fixed cost equals 288,000. My variable cost per unit was $14 per unit. They had the revenue is $20 per unit. So break even, the first thing I want to do is set up the equation. So I'm going to take the $20 per unit times the number of units, and we don't know that, minus the 14 units times X, minus 288, and that has to equal 0. So we have 20 minus 14, that's 6X, minus 288 equals 0. Then algebra 6X equals 288. So X will equal what? 288 divided by 6, 48,000 units. So the break even in units. All right. So then how do I find the revenue, the break even in revenue? Well, they're going to sell this at a $20 per unit. So I'm going to take the 48,000 units, multiply it by 20, and I get $960,000. Okay. Now, calculate the number of units must sell in order to earn a before tax profit of 1,200,000. I'm going to use the same equation, 20x minus 14x minus the 288. And this time I'm going to multiply it or equal by the 2 million. 1,200,000. So I have 6x minus 288 equals the 1,200,000. So 6x equals $1,488,000. So then x equals him what? If I take that 1,488,000 and divide it by 6, I get 248,000 units. Now, if we want to figure out, this is the units, and in the amount, I'm going to take the 248 and multiply it by 20. I get 4 million in revenues. Okay, let's just double check this. If we take the 248 million and multiply it by my variable cost, and then take out my fixed cost, and if I subtract all these, I should get the 1.2 million. Now, how much can they drop in sales revenue before a loss incurs? So I take the 1.2 million and I'm going to subtract my break even of 960 in revenues. So I have to do $240,000 in revenues, or I have that much I can drop. If I do it based on the units, I'm going to take the units of 2848, and my break even units was 48, and so that's my units. Let's do this. Let's do 248, and then the break evens in units. So that's my margin of safety in units. Now it says calculate. All right. Calculate the number of units, which we already did, was 248, for an after tax profit. So let's go back to our formula up on the one before. The after tax before income equals the after tax divided by the one minus the tax rate. Okay? So my after tax, I don't know what that is, but if I want 1,200,000, and I'm going to divide that by 1 minus the tax rate, and remember you have to convert the tax rate into a decimal. So I have x equals the 1,200,000 divided by 0.65, and so x equals 1,860 or 46,154. Okay. And now, what is the contribution margin ratio? So again, how do I do that? We have a revenue per unit. So the revenue per unit is $20. My variable cost is 14. So my contribution margin per unit is $6. Now, how do I get the contribution margin? I take the $6 divided by the unit price of $20, and let's convert that into a percentage here so you can see that. And my contribution margin ratio is 30%. So I hope that helps you understand that problem a little bit better. And let's move on to the next part of this. All right, so you also need to know the difference between variable costing and absorption costing. Remember, variable costing involves all variable costs in the top part of the income statement. So no matter what type of variable cost it is, it goes up on top. So that includes direct labor, direct materials, variable manufacturing overhead costs, and any variable costs related to the selling of the products. Absorption costs is just the manufacturing. So that would be direct labor, direct materials, and both fixed and variable overhead costs. Product costs, remember those are the product, the cost for the product itself. Variable product costs, and the difference between variable and absorption, which is the fixed manufacturing overheads. Okay. All right, so here's the things that you need to know. And for variable costing, it's only used internally. It's not for the general public because it does not follow GAAP, whereas absorption costing does. Another name for absorption is full costing. So if you see that on exam, when they say full costing, you know that they're talking about absorption. Variable costing only includes variable product costs. So uh, it does not include the fixed manufacturing overhead. I take that back. Earlier, I said it included the variable selling costs. Um, does not, and it's a of unit product cost. Fixed manufacturing overhead is treated as a period cost expense, and then uses contribution margin income statement format. Now, absorption is where we include the fixed manufacturing overhead. It treats variable and fixed selling administration as period costs and uses the traditional income statement format. So let's look at one of the examples. We have Laner Company has the following data for the production of and sale of 2,000 units. What is the cost per unit? So we have an $800 selling price of $800. We have marketing fixed cost of 400,000. We have manufacturing fixed cost of 200,000, and then we have the variable costs. So which ones do we deal with? We have for the absorption costing, we take all of this down here. So my direct materials is $200 per unit. My direct labor is $100 per unit. My variable manufacturing overhead cost is the $80 per unit. The marketing and administration is used for a period cost. And so then I also have the fixed manufacturing overhead. Now, how did I figure that up? I took the 200,000 divided by the 2,000 units that we produce, and it's $100. So my cost per unit is a total of 480. Now, for the variable cost per unit, remember it only deals with the variable cost in the production. So all it's going to have is the manufacturing overhead of $80, direct materials of 100, and direct labors of 100, and direct materials of 200. So my variable cost per unit is 380. Okay. Now, here's another one. You need to know how to do a income statement. So remember, you have the contribution margin uh, method the um, for the variable, and then you have a regular income statement for the assumption. So let's look at the variable income statement. The first thing we're going to do is we have 85,000 units sold, and we're going to sell them at $30 per bucket. And so I take the 30 times the 85,000, that gives me $2,550,000. Now, my variable cost per unit, variable costing, remember, includes the direct materials, direct labor, and the variable overhead manufacturing costs. So in this case, we have direct materials of $200,000. Now, how did I get the cost per unit? I'm going to take we produce 90,000 units here. And so I take the 200,000 divided by 90, I get $2.22. My labor cost is 320,000, so I take the 320 divided by the number produced. That's how I get the $3.56. Then my variable manufacturing overhead is 155,000. To get the cost per unit, I divide that by 90,000, I get $1.72. Add those three numbers together is $7.50 per unit. That's the number that I use to multiply by the number of buckets I actually sold, which is 85,000. So 85,000 times 750 gives me 637,500. We also put in the variable costs, selling administration costs. So I was right. You do put in the variable selling administration cost, which is, if you go up to variable manufacturing, general administration fixed, variable selling was $2 per unit. So we take the $2 times the $85,000 units we sold. That's how I get the 170. So my contribution margin is 1,742,500. So all variable costs. Remember, variable income, to get into the contribution margin, you have to use all variable costs. Then after the contribution margin, we take the fixed manufacturing overhead, which they told us was 396,000. The fixed selling administration fees were 60,000. So my operating income is 1,286,500. Okay. So now in absorption, we use the same thing, but we also throw into the fixed manufacturing overhead. So the fixed manufacturing overhead were 396,000, and divide that not by 90. That gives me $4.40 per unit. So I add that to the 222, the 356, and the $1.72, and that comes to $11.90 per bucket, or yeah, per bucket. So I multiply that by the 85,000 that I sold, and I get 1,100. I'm sorry, 1,011,500 for my cost of goods sold. Take that from the revenues. My gross margin is 1,538,500. And so then we have the variable selling and administration costs of 170. How did I get that? I took the $2 per unit times 85,000, and then my fixed cost of 60. So then I have 1,308,500. So make sure you understand the difference between variable and absorption costing, and know how to put together an income statement for both. All right. So now reconcile the difference between the different ones. Uh, the fixed manufacturing overhead is always the difference between the two operating incomes. In absorption costing, the operating income was 1.308,500. If we take the $4.45, that's how we come up with the difference. In the variable costing, we take the whole amount out. So the difference is the 22,000. That if I take the 5,000 times, I'm sorry, the 440, the $4.40, and multiply it by the $4.40, multiply it by the 5,000, that is the difference. So the difference is always the difference between the two amounts, or the fixed manufacturing overhead per unit times what the inventory is. Okay. All right, so that pretty well wraps up the review. Just make sure that you understand everything that we've covered in all the homework assignments. And I'll get up a notes here soon about the things that you just need to hit to make sure that you understand. Again, you get a 3x5 card, one side only, to take with you. You need a scientific calculator or a regular calculator. You can't not use your cell phone, and cannot use a graphing calculator. And remember to make the appointment as soon as possible to get this done within the given time frame. Again, if you have any questions, please do not hesitate to ask, and have fun studying. Thank you and have a great day.